Okay, so this is your quick cliff notes of options, incredibly broken down, super simple, without getting in a whole lot of details, just for the purpose of buying and selling options on the basics. So we're going to do the SPY. Um, just like I was showing you before, you can scroll and see all the price action for the day. Market's closed right now, so we're going to talk about options for tomorrow. So you would go and hit the trade button. Instead of hitting buy, where you see buy, that's where you would buy your regular stocks. Or if you want to try to buy one stock, you got to pay $517. Or if you buy an option, don't worry about any of this stuff down here. See all these numbers up top, all these dates? These are the dates where your options expire. Each option has a expiration date to them. They're not like a regular stock that you can buy and just hold it until whenever you decide you want to sell. These are time-based. Part of why they're so explosive in volatility and making and losing money. We're going to start with May 8th. So with May 8th, stocks will have anywhere from a 1 day or 0 DTE, what they call days till expiration, all the way up to, you can go years on out. So for tomorrow, everything that you're seeing here, you see calls. Well, we have calls and we have puts. Oops. So with calls, that's when you're anticipating the stock price is going to go up. And with puts is when you're anticipating the stock price to go down. We'll focus on calls at the moment. So if you wanted to say that, okay, the stock is going to go to 518, your 518 call, as you see here, is 81 cents. If you tap on it, you'll see that when the market closed, the last bid and ask price was right around 80 cents. The implied volatility here in the corner, that's how much interest is in that at the moment. Of course, when the market closed, there's no price action going on at the moment with options. So it's not a whole lot of anticipated movement right now. Down here, your chance of profit is telling you right now this option has a 29% chance of profiting. Your volume had 180,000 transactions for this particular strike price. The 518 call is a strike price. 518, 519, 520, they call those strike prices for where you're anticipating the market to move to. Open interest is just saying how many people are currently interested in the stock or in this option. Then we go into the Greeks. Refer to the video I sent you a couple of days ago. The main things you want to focus on is your implied volatility, tells you how much interest is going on. Your delta, this is how much your option is going to change for every dollar the stock moves up. Your option is going to add or subtract $39.84. The theta right here, that's your time decay. Because these have expiration dates, you also have what they call time decay. If we go into the buy process, you see that the 81 cents now is $81. It's because your options are the option to buy 100 shares of a stock. If we hit this little max cost here, and that's why it has the 100 multiplier towards it for one contract. One contract equals 100 shares. Now, you're not buying 100 shares of SPY. You're having the option to buy 100 shares of SPY. You'll never go through with what I'm teaching you right now. You'll never go through the process of actually needing to buy 100 shares of SPY. So we'll get back out of here. It's the same with, puts and things like that. It's the same process. It's just if you thought the stock was going down. Right now, the share price is saying the 517, which is, so this put here is what they call at the money. If you do the 517 put, that's technically at the money. If you go to 518 put, that's outside of the money. And if you go 516, it's in the money, meaning that everything below this line here of the share price is technically in the money. But since we're so close to 517, I just say that's at the money. But if we tap on, we see it's relatively the same price as between a call and a put, which tells you because there's a couple cents more to pay for a put is more indicating that that's kind of where the market was leaning towards at the close is the downside. But it's still the same process. If you go to buy it, you're going to spend $83 per call or per contract. That is the basics of options. So instead of paying $517 for a share, you're going to buy a put, or a call. It makes it so that it's more affordable to trade these big stocks. You get like Tesla or Apple or Nvidia. They're worth hundreds of dollars. Well, instead of buying 100 shares of those, which would be quite a bit of money, you can buy for $81. You can buy 100 shares. And it's the same, when the whole volatility of the market moving up and down. That's why if you look at all these different prices, the red and the green. So the red is out of the money, green is in the money. If you're kind of just eyeballing on how much money you can make if the stock moves, well, let's say we take a look at the 518 for $81. And then if the stock were to move $1, so let's say it goes up to 518.23, roughly what your call would be worth then, look at the 517. It's $1.36 or $136. That's the rough estimate of what you're trying to make. If you're trying to make a trade on the fly and trying to figure out, okay, if it's going to be worth your time or not, or has enough risk to reward. Okay, well, if the stock moves $1, if it looks like it has range to move $1, okay, well, I can make a quick, $56, $55 from this if it moves $1 right now, the way things are set up. And that's kind of how you plan out your very, very basics of buying option contracts. If it's going to move up or down, okay, where do I want to be? What kind of profit am I looking for? Let's say your account's small, you don't want to put $81 down. Okay, well, you still think that the market's going to move $1, right? You think it's going to go up to 518? Okay, well, you got 520s right here that are worth $20. Well, instead of spending $80 for one, you could spend $80 and get four, and be the same thing. If it moves $1, okay, so you can anticipate that your 520 call is going to be worth $43. So that's $23. But if if you bought four of them, now you're looking at $92 for if it moves $1. So sometimes there's more value in buying farther outside of the money if you're anticipating a big move in the market. And that's how I've been making my money, is I do more value. You have more value with less risk up front. Instead of buying the one and maybe making 55, well, you spent the same amount of money, you've made almost twice as much. And it goes the same way if it's going up or down. Other thing I want to point out too, as well, when you hit the call here, it'll tell you. Oh, I guess it doesn't until you actually purchase it. Okay. When you purchase your option, it'll give you the final total when you go to see it in your account. It tells you what your break-even price is, without getting into too many details at the moment. More or less, your break-even is, so 518 says the market needs to hit at least 518 to break even, just to make it basic information. Otherwise, if the stock market doesn't end at 518 when this contract expires, it'll expire completely worthless. So you want to make sure that you're either trading it when the market is moving, or that you get out of the transaction before it expires. Otherwise, you lose all of your money. But the thing about contracts as well is that you're only risking what you buy in. You're not going to lose any more than what you buy in. That's the only thing you're risking, is what you buy in for your contract. So if you buy the 520 call for $20, that's what you're risking to losing, is $20 if you let it expire worthless. Simple enough. I'll end this one here.